Hello everybody. In this session we are talking about operating expenses. Operating expenses or opex refers to the costs incurred by a business for its operational activities. In other words, operating expenses are the costs that a company must make to perform its operational activities. Operating expenses are essential for analyzing a company's operational performance. It is therefore important for both internal and external analysts to identify a company's opex, to understand its primary cost drivers, and assess management efficiency. And then, what is included in operating expenses? Operating expenses include all the normal indirect costs of doing business. Operating expenses vary depending upon the size and type of your business. But some common operating costs include payroll for staff, travel expenses, insurance, vehicle expenses, license fees, property taxes on real estate, rent, attorney fees, research, utilities, marketing, office supplies, accounting fees, building maintenance and repairs, etc. Then the types of operating expenses. OPEX can be categorized into two main types. The types: fixed expenses. These costs remain relatively constant regardless of production or sales volume changes. Examples include rent, insurance premium, annual salaries, and depreciation expenses. Fixed expenses are more predictable and stable, providing consistency in financial planning and budgeting. And then the second, variable expenses. These costs fluctuate directly with production or sales volume changes. Examples of variable expenses include raw materials, direct labor costs, commissions, and shipping expenses. Variable expenses can significantly impact a company's profitability as they directly affect the cost of producing goods or delivering services. And then operating expenses in accounting. Accounting, a company's gross profit is shown as the first line item on the profit and loss statement. It is operating expenses are shown immediately after this. Deducting the operating expenses from the gross income gives the operating income. Non-operating expenses are shown next once these costs have been deducted from the company's operating income. The money left over is the company's net income or net profit. The net profit can be used to calculate the net profit margin. And then how to cut operating costs. Research suggests that a 1% decrease in operating costs can increase profitability up to 10 times more than a corresponding increase in revenue. With a clear view of operating costs, you can identify areas that appear too costly, then break out and examine them to find opportunities for cost savings. And then there are a few common ways to reduce operating expenses. First, review utility bills. Have they gone up over time? Look for energy efficient investments such as motion sensor lights. Second, evaluate options for internet or cable and insurance providers. See if another vendor offers a more competitive price. And then, what are non-operating expenses? Understand what is an operating cost. So, this isn't all that difficult. Expenses not directly related to a company's primary operations are non-operating expenses. They are not necessary for the day-to-day operation of the business. Non-operating expenses appear towards the end of an income statement after operational expenses. A few examples of costs unrelated to regular business operations are interest payments. Keeping operational and non-operating costs separate will make it easier for stakeholders to understand the company's performance. And then, why operating expenses are important? If you're a business owner wanting to improve the bottom line, you have several options, but reduce operating expenses may be the best one. That's why the first, you can try increasing the price of your product or service to increase revenues, but customers may not be willing to pay more. And then the second, you can try decreasing your COGS or cost of goods sold by using cheaper labor or materials, but quality may suffer and lead to lost business. On the On the other hand, operating expenses typically don't directly impact price on quality. So, controlling operating expenses can improve your bottom line without making your product worse, meaning you can keep more cash in your business. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment and subscribe. Thank you.